Hello, and welcome to the BDO Federal Budget webinar. My name is Neil Billiard. I'm the National Head of Tax here at BDO. Today we have a number of speakers to analyse and dissect the budget for you. As promised, there are two speakers to talk about the tax aspects. We have had a number of questions and things that people want us to talk about, so I have asked those speakers to deal with those questions as part of the presentation. In addition, we've also had requests for people to talk about aged care, which is a big part of the budget, and also infrastructure. So at the back end, I've invited two speakers from our specialists in those areas to give some insight into the impact of the budget on those areas. So, in addition, you will get a recording of this after the session. So if you have any further questions, please follow the links and we'd be happy to deal with those questions at that point in time. So in terms of the speakers we have today, as promised, two tax speakers to start with. So Mark Molesworth, he is a partner who is actually responsible for preparing our budget brief. So he has deep knowledge of the content. He's also the gentleman that's been doing a number of videos prior to the budget around tax policy and what we hope to see in the budget. So hopefully the government's delivered on a lot of those videos and requests. So Mark will speak first. He will deal with corporate tax changes. And then James Trainer he's a specialist in our expatriate tax, employment taxes and individual area. So he'll go through some of the specific changes dealing with individuals. I've then asked Fahid Kondaka. Fahid is a data analytics specialist, but his claim to fame is that recently he was an expert witness at the Royal Commission on Aged Care. So I've asked him to talk about what he's seen in the budget in terms of aged care and what it means for that sector. And then lastly, Grant Morris, he is the New South Wales leader of our infrastructure practice. So I've asked him to give some insight in terms of the budget impact on infrastructure. So please enjoy the content, and I'll hand over to Mark to get into the detail. Thank you.
Thanks, Neil, and welcome along to everybody online today. I've been asked to talk about the business tax measures that were contained in this year's budget. It's fair to say, despite the introduction that Neil gave me, the government completely failed to listen to us in terms of what we're asking for. And in fact, this would be one of the more recent budgets which has very few tax changes in it. And so my comments are going to be necessarily relatively short and relatively limited. Probably the biggest ticket item for most businesses that came through in this budget was the extension of two measures that were put in place at the beginning of the pandemic for an additional 12 months. They were the immediate expensing of new depreciating assets and the loss carryback measures. Both of those were originally designed to finish on the 30th of June 2022, and the government announced in this budget that both of those will be extended out until the 30th of June 2023. What the immediate expensing measure allows for is for businesses with less than $5 billion in global turnover to immediately write off the cost of new depreciating assets. The loss carryback measure allows businesses, companies in particular, that were taxable in prior years, so in the 2019 or later years, who then find themselves in a tax loss in a later year, to carry that tax loss backwards. So rather than having to carry the tax loss forward and offset it against future profits that they make, they can carry it backwards, offset it against previous profits that they've made, and claim a refund of the tax that's already been paid. Both of these provisions are beneficial to businesses, and one can impact on the other. So the immediate expensing of depreciating assets can give rise to a loss, which is then able to be carried back. So they're valuable for particularly companies, but all businesses who find themselves acquiring new depreciating assets. The measure that I think nobody saw coming in this budget, and certainly nobody was predicting before it was handed down, was the government's announced the introduction of a patent box regime. Now, it's a very specific and very narrow patent box regime, limited to medical research and biotechnology patents. What the patent box regime allows for is for royalty income from those particular types of patents to be taxed at a lower corporate tax rate. So the general corporate tax rate at the moment is 30%, or for small business companies, 26%, and then 25% next year. The patent box regime income will be taxed at a corporate tax rate of 17%. So that's a significant, indeed, almost halving for some companies of the tax to be paid on that sort of royalty income. Now, in the short term, the big beneficiaries of this patent box regime will be large medical companies that are actually profitable based on their patents, the likes of CSL, Cochlear, those sorts of companies. Over time, however, we expect that this measure will encourage other medical research and medical development companies to keep intellectual property onshore in Australia and to receive the worldwide royalties for the use of that intellectual property in Australia, because the tax rate will only be 17% on that income. But in the short term, a lot of early stage research and development companies won't actually have tax payable, and therefore whether the tax rate is 30%, 25% or 17%, frankly won't make any difference to their decision making at this point. But it may give them a strategic incentive to maintain the intellectual property onshore. Carrying on down the intellectual property line, the government also announced that the depreciation rate for intangible depreciating assets, which are broadly copyright registered designs, patents and plant breeders' rights, will no longer be set by the law. So at the moment, the depreciation rate for those types of intangible intellectual property assets is set by the law and you can't change it. What the new legislation is proposed to allow is to allow companies to self-assess how long or over what period their intellectual property will be useful. Now, that's going to be particularly interesting to software development companies, amongst others, because to the extent that they are creating copyrights, the current depreciation rate on copyright is 20 years, and I think it's fairly evident that most software does not have a shelf life of 20 years or a useful life of 20 years. It is being redeveloped and replaced in its entirety much more rapidly than that. So I think there will be some types of taxpayers who will benefit from that announcement. Finally, two relatively small but interesting measures that have been proposed in this budget. The first is to allow small business taxpayers, and in this case that means taxpayers with a turnover of less than $10 million a year, to apply to the Administrative Appeals Tribunal if they are disputing the fact that they owe a tax debt, and allow the Administrative Appeals Tribunal to put a stay on tax office recovery action while the dispute is resolved. At the moment, there's pragmatically no real way for a small business taxpayer to stop the tax office starting recovery action, even if a tax dispute is in place. This will give the tribunal and give businesses the ability to, in a fairly cheap way, prevent the tax office from taking debt recovery action. The final measure I want to talk about is applicable to not-for-profit entities that are not charities. At the moment, not-for-profit entities that are not charities are able to self-assess whether they are exempt from income tax or not. So we're talking about things like the local football club, local tennis club, community organisations, those sorts of entities. The proposal from the government is that rather than just being able to self-assess that they are income tax exempt, they will still be able to self-assess, but they will have to tell the tax office on an annual basis that they have self-assessed themselves and they have looked at their activities and they are indeed still income tax exempt. As you can see, there aren't actually many substantive measures in this budget. There is absolutely no smell even of real structural tax reform. We think this is a bit of a missed opportunity, but this is what the government has delivered us in this budget. Now I'm going to hand you over to James Traynor. James is a partner in our employment taxes area, and he's going to talk about some of the individual measures in the budget. Over to you, James.
Thanks very much, Mark. As Mark said, I'm going to go through some of the individual tax changes or the tax changes that will impact individuals. And it's important to remember that the changes in tax really go hand in hand with changes to the transfer payments that the government's making. So things like changes to the childcare subsidy. And what the government here is trying to do is really boost participation in the workforce and try and put more cash into the hands of workers. Might be an election coming up, who knows? But cash in the hands of workers is always something that governments are happy to do. The big ticket change that came about in the budget was the extension of the low and middle income tax offset. This was flagged well before the budget came out, and what it will do is it'll provide about $1,080 into the hands of workers up to about $90,000. And they'll do this by claiming the offset in their income tax return. Above that, it starts to phase out, and so above $126,000, then it's completely phased out. So definitely targeting those low and middle income tax individuals. And it also helps the government's narrative around helping females, because typically it's about 60% of workers in that space that are female, and so they'll be the major beneficiaries of that offset. There's also some changes to the Medicare levy thresholds, so the low income thresholds. They'll move up with CPI, and so again, it'll mean that there are fewer individuals who are paying Medicare levy at those lower income levels. There was also a small change in relation to self-education expenses, and this will make it a little bit easier for individuals to claim deductions for self-education expenses. And so there's been this historic anomaly where the first $250 of self-education expenses weren't deductible. That will be abolished, so all self-education expenses will now be deductible. The other significant change that's come about in the budget, or that's been proposed in the budget, is a change to the rules around individual tax residency. The rules currently in place in the legislation have been around for a very long time. And if anyone tries to navigate through those rules, essentially you're required to go back through case law to determine, am I a tax resident of Australia? What the government is proposing is to pick up on recommendations that were made by the Board of Taxation back in 2019. And what the recommendation is to do away with these more subjective tests and move to a more objective test. And so that you basically create a flow chart for individuals to work through to determine whether they're going to be a tax resident or not. And so it's about simplifying the rules. It's certainly not about trying to reduce or increase the number of people who are a tax resident. It's all about simplification. And one of the things that might come off the back of this is that individuals who you might not have thought were going to be tax resident now do get caught as being Australian tax residents. So it might not pick up on all of the benefits that perhaps the Treasurer was talking about on budget night when he was saying we'd have all of these people, perhaps high net worth individuals from Hong Kong coming to Australia and spending time here. So the way the rules will work is it'll actually put in place a two-step process. So the first step is, am I in Australia for more or less than 183 days? So if it's less than if it's more than 183 days, then you're a resident, you're in, you stop doing any further analysis. Alternatively, if you don't satisfy that first test, so you're here for less than 183 days, then you go to this secondary test. And the secondary test involves sort of two parts. One is about your presence in Australia. So if you're here for less than 45 days, for example, and again, this is based on the Board of Taxation recommendation, so we still need to see the legislation to work out the exact nature of the tests. But following along those recommendations, if you're here for less than 45 days, then generally you're not going to be a resident. But if you're here for more than 45 days, so 45 to 183 days, then you need to look at a bunch of other factors. And there's 4 factors that the government is looking perhaps to put in place. And that's things like your ties to Australia. Do you have Australian citizenship, or are you a permanent resident? Do you have Australian accommodation? Do you have a family here in Australia? And fourthly, what are your economic interests in Australia? And so you look at those factors, and if 2 or more of those are satisfied, then you'll be a resident of Australia. So very formulaic, but as with most things in tax, we really need to see the detail come out in the legislation to see what the results are going to be. So look, probably for most of individuals who have relatively uncomplicated affairs, it probably does make things simpler, but certainly there might be another group who's come into and out of Australia a lot during the year. And for those people, it might make things a little bit more complicated, or indeed might make them residents when they perhaps didn't think they were going to be residents. The other change that I want to touch on in relation to income tax is a small change around employee share schemes. But given I've been fighting for this since 2009 when the share plan rules changed, I'm pleased to finally see the government has listened. And the change is to remove cessation of employment as a taxing event for share schemes. So currently, if someone leaves employment and gets to keep their shares and they haven't been taxed yet, when you cease employment, that results in a tax liability. That will be removed going forward. Probably impacts senior executives a little bit more, who might find that their share awards, are kept subject to vesting conditions post termination of employment, just to make sure that there's no cooking of the books or anything like that happening whilst they were an employee. So that's a favourable outcome, and we expect that to see or come into place 1 July following royal assent. Turning now to superannuation, the big ticket change here for individuals and for employers for that matter is the proposed removal of the $450 per month wage threshold at which employers need to contribute superannuation. So at the moment, if you have an employee who earns less than $450 per month, then the employer doesn't need to contribute super for them. And this really disproportionately impacts females, and it also impacts people who might work at a number of different jobs, so perhaps people in the gig economy. And so the removal of this $450 threshold will see about 300,000 workers now become entitled to superannuation. So that's a good thing. Of course, small amounts in super tend to get eaten up by administration fees and the like, so there's some work that will need to be done there to ensure that it still provides a reasonable benefit for individuals. There are a couple of other smaller changes in relation to superannuation. There's the proposed abolition of the work test for people aged between 67 and 74 to make contributions into super. That's non-concessional, and also salary sacrifice contributions into super. So that's a positive thing, allowing older Australians to continue to make contributions to their superannuation accounts to set themselves up for retirement. There's also been an extension of the downsizer contribution. So this is the case where individuals sell their family home and they're able to put the proceeds of that up to $300,000 into their superannuation account. So the age at which you can do that is dropping from 65 down to 60. The final point I want to touch on is a very technical point, but in the employment taxes or the expat tax space, it causes a little bit of concern. And this is about relaxing some of the rules around tax residency for self-managed super funds. So what these rules will do, or the changes, will extend the time from 2 years to 5 years for which someone can actually be temporarily outside of Australia and still maintain their Australian superannuation or self-managed super fund as an Australian super fund, and that allows them to make contributions to that fund and also ensures that that self-managed super fund doesn't become non-complying, which is a disastrous result. So those are just some issues around individuals and superannuation, which we picked up coming out of the budget. I'll now pass on to Fahim, who's going to talk through some of the policy changes that are coming through around aged care. Over to you, Fahim.
Thank you very much. Hi, everyone. In relation to aged care, just by way of background, BDO was engaged by the Royal Commission into aged care, and our job was to assess the viability of the sector and the profitability of the sector. And I actually had the privilege of presenting as an expert witness at the hearing. Since the Royal Commission, we've worked with the industry to essentially analyse the Royal Commission recommendations. And for those of you who are not in aged care, all eyes for the sector was on the budget in terms of what the government was going to do in relation to the Aged Care Royal Commission recommendations. And yesterday they released their response to the recommendations as well. So it's actually very, very difficult to talk about the budget without talking about the Royal Commission and the recommendations themselves. So with that, I've just prepared a very quick overview of the Royal Commission recommendations. And in 24 hours, we've just turned around a little bit of analysis on what the government has accepted and hasn't accepted. We're going to do a more detailed deep dive into that in about 2 weeks or so. So please keep keep look out for that, and please attend that event as well. And then I want to finish off by talking about what's in the budget in terms of dollar figures and which items are worth noting. The one thing to note at the very outset about the dollar figures in the budget is I think it's going to be the subject of much debate in the coming months. Whether the extent of the funding is enough is going to be what's going to be debated, and whether everything that requires funding was funded is going to be the other argument as well. So watch this space. I don't think this is something that's going to be set in stone, and there's going to be a lot of discussion there. So with that, I just want to give you that overview of the Royal Commission recommendations first and the government's response, and then we'll jump back into the dollar figures. So I'll share my screen, and please bear with me. Hopefully it'll all work. I'm hopeful that everyone can see this. So what we did at the top graph is there were 148 recommendations from the Royal Commission, and we worked with industry providers to categorize them into more useful categories in terms of what they may impact. And there's obviously overlap. One recommendation can impact multiple areas. And we had a look at it, and we categorized them into workforce, quality of care or care, governance, operational impact, structural impact, and finance. And you can see there's significant governance requirements, there's significant financial requirements, and then care and workforce were quite significant as well. In the graph below, which I'll just maximize for you, we can see which ones the government has accepted, and the dark shading. Apologies if anyone's colorblind. The dark shading of the blue is all they accepted. The slightly lighter one where they accept in principle. They've identified quite a few that they think are subject to further consultation. They've flat out rejected 6. They've noted 1 is being addressed elsewhere, and then they've kind of picked one or the other on a couple of things as well, which I'll talk to in a sec. So with that, it's probably worth noting. So let's start with what they don't accept. And the government has flat out said they were not going to accept recommendations 127, 128, 129, 138, and 141, which means nothing, but the common word in there is fees. So any recommendation associated with fees and means testing were basically flat out rejected. And in some cases, the government also noted that the commissioners didn't agree amongst themselves on the approach. And this was always the challenge when the commissioners disagreed as well on whether you could at least accept one or the other, or you'd reject both options. So that was quite an interesting approach, and I think this will be the subject of much debate going forward. There was a Productivity Commission investigation that was kind of mentioned in the Royal Commission as well, and to link the two, and the government has rejected that one as well. So that'll be quite interesting, and we'll do a deeper dive into all of this in a couple of weeks. The other one worth noting is there was a recommendation talking about increasing the award wages, and the government has basically noted that that will be considered by the Fair Work Commission. So it's basically not responded to it in its response to the Royal Commission recommendations. The final one for the supports instead, there are 4 of them. It's quite interesting to note these ones as well. So they've basically gone with not the independent aged care commission. They've gone with the government-led departmental governance model that one of the commissioners agreed. The pricing authority was very interesting as well. They've gone with the expansion of the existing hospital pricing authority rather than an aged care pricing authority, which is one of the recommendations between one of the commissioners. Indexation arrangements, they're talking about how they've come up with a different way to fund that, and they're coming up with a new supplement of $10 per day per resident. And then talking about an implementation unit where basically, again, same thing, there was some discussion about a separate versus within government, and they've leaned towards anything that stays within government is probably the better way to go. So I won't go into too much more detail at this stage, but as I said, we are doing a lot of work now analysing the implications of this for everyone, and we'll do a deeper dive into that. I'm just going to stop sharing my screen so you can see me a bit better, and I'm now going to just move into the conversation about what's in the budget in terms of dollars. As you know, there's about 17.7 billion, so I'll just call it 18 billion for this purpose, over about 5 years. So that averages only about 3.5 billion a year. About 6 items make up 85% of that 17 billion, and I just wanted to cover those off today. And then I've called out some that were quite interesting because they were being advocated for or noted by the industry as stuff that's or important, or the Royal Commission found it quite interesting as well. So, and a couple of those I've called out, and I've called out 6 of those as well that I want to just cover off. So let's talk about the big ticket items. So about a third of the funding relates to the release of additional home care packages. So they want to release 80,000 home care packages, and that's about $6.5 billion worth. The big elephant in the room is the workforce to support all this. So, and the industry has been advocating quite strongly for that. There's about 800 million to provide greater access to respite care. And here's an example of some funding, and the detail will be quite interesting to explore in the coming weeks, where of that 800 million, they also talk about paying support workers from it. Then there's about $4 billion to increase the amount of care time that a recipient, an elderly person, receives. And they've effectively stipulated that everyone will get 200 minutes per day, and at least 40 minutes of that will be a registered nurse. So that is effectively, indirectly or directly, depending on your view, showing that staffing ratios are basically being implemented in some way, shape or form. And then there's this new government-funded basic daily fee supplement, which I was talking about earlier. So $10 per resident per day. That makes up about $3 billion, about what's that, 1/6 of the total funding. And then the final one is regional Australia, which is worth calling out as well. There's about 630 million being put aside for that as well to improve access in regional areas. So all of those items add up to roughly, I think I did the maths, about $15 billion or so. Then there's some interesting ones to call out as well today that I just wanted to note. The government has accepted the notion of a new Aged Care Act, and that was one of the biggest outcomes of the Royal Commission, which was to enshrine the right to aged care into law. So they've put aside $25 million or so around for that. There's a National Advisory Council and a Council of Elders that was promoted as well. And the government has accepted that and put some money aside for that to advise government policy. There was money put aside to help individuals get more information, to get their friends and family into aged care. So if you're looking for information for your parents, there's some funding put aside to make that information more accessible to you. There's a new star rating system for giving like 5-star reviews or 4-star reviews for aged care providers that individuals can now do, so similar to Google reviews. The amount was quite big, so it'll be interesting to see the details. Of $200 million put aside to set up that new star rating system. There's a new funding model called the Australian National Aged Care Classification. Again, not sure of the detail of that, but again, 200 million is being put aside for that. And then the final one, and I don't want to scare anyone, but it's definitely one to keep an eye out. Because the number was small, it kind of even slipped our radar initially. There's $117 million put aside for structural reform, and the wording says that they want to discontinue the current bed license agreement and the aged care approval round process from 1 July 2024. That could have significant ramifications depending on how that's played out and how that impacts the value of a bed license. From memory, it was quite a significant few $1 billion in the whole overarching balance sheet of the industry. So it'll be interesting to see how that plays out and the implications of that. Our BDO's technical accounting team is looking at accounting standards and the implications of that as well. So you'll probably see a lot more information from BDO on this one, and it's definitely one to keep a very close eye on. So that's probably the big high-level ticket items. As I said, we'll do deeper dives into the Royal Commission recommendation responses. We'll do deeper dives into aligning these dollar figures into the recommendations as well, and keep a very close eye working with the industry and the peak bodies, as well as the government as well, to keep an objective view on what is happening. And so please keep in touch and get in touch as well if you'd like further information. With that, I think I have to set up grants screen, and I'll do that now. So hopefully that's all on screen, and I'll get off the webcam. So thank you.
Thank you, everyone. From an infrastructure perspective, the Commonwealth Government has invested another 15.2 billion nationally, and that'll create about 30,000 jobs over the next 10 years. In terms of distribution of the spend, predominantly it has been targeted into Queensland, New South Wales, Victoria, and Western Australia, and really it's the priority has been placed on transport infrastructure, particularly around freight movement and state and national road networks. The infrastructure spend is really about topping up existing infrastructure programs and co-contributions to existing state and local government projects that have already been on infrastructure pipelines for quite some time. Stepping through some of the key priorities and highlighting state by state, the Bruce Highway has been a significant priority for the Queensland Government for quite some time around flood and safety and capacity, and making improvements, particularly north of Capricorn, is a key priority, and 400 million has been invested in that space. An additional 240 million has been invested in Cairns as well. In New South Wales, $2 billion has been allocated to the Great Western Highway to Transport for New South Wales to deliver the Katoomba to Lithgow road upgrade, which is quite a significant tunnelling exercise underneath the Blue Mountains. That project at the present time is in business case phase and will move into construction in the next 2 or so years. In Victoria, the spend is really focused again on freight movement task, and $2.6 billion has been allocated to a large freight intermodal facility in Melbourne itself. Moving across to the West Coast, in Perth, the priorities are subtly different, and investments being placed into the Metrolink, which is a new extension to passenger rail corridors to the northeast of the city. I suppose the key message is that the jobs and growth in regional Australia is important. There has been quite a significant allocation of funding to road safety and community infrastructure projects, and with each state receiving a healthy allocation, particularly in Queensland, about $460 million, and in Western Australia, $280 million. So quite a significant funds to local councils and state governments for very tactical and small infrastructure projects in that space. I suppose lastly, the importance of investing in transport infrastructure is quite significant to the freight movement task, and obviously keeping the economies moving. We do have a high reliance on road network for the movement of our goods and freight, and I suppose there has been quite significant investment in past budgets with inland rail from Brisbane through to Melbourne. Where I suppose there is opportunity for growth is in other sectors, and particularly the energy sector. There is opportunity to grow some investment in those spaces, particularly around some of the renewable energy plays and in that space over the next period. I think that's a high-level summary. The diagram there provides quite a detailed overview of the key priorities, and happy to take questions at a later point. Might pass it back now to Neil to close the session.
Thanks, Grant. So hopefully everybody got a lot out of that session. A little bit different this time round. We covered the tax stuff, but also had a look at some of the more commercial economic stuff around infrastructure and aged care. So hopefully that was valuable to you. As I said, this has been recorded, so you will get a link after this session. So if you want to watch it again or show your friends, please feel free to do that. And there's all our contact details as well. So if we haven't addressed your questions or you've thought of more questions, please feel free to reach out. and we'll be happy to deal with those questions. Thank you for your time. Look forward to seeing you next time. Bye-bye.